Hello, chart watchers, and welcome to this Tuesday, March 26, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got the Dow Jones Industrial Average trying to move higher today. We did pull back off the earlier highs, but still, we are up 171 points on the Dow. The S&P 500 up nearly 21. The NASDAQ up 60 points. We were up quite a bit higher earlier, but we have pulled back as we did with the other indices. Russell 2000 up 13 points, back up above the 1525 level. 10-year Treasury yield up 1.5 basis points. That's unusual. I haven't seen that much lately, but we are still down from today's open. So still some downward pressure on the yields. Volatility index yesterday tried to get up through 18, failed, came back down, and we are seeing the volatility drift lower once again. Energy moving up today. Crude oil prices actually went above $60 a barrel just a few minutes ago. First time that's happened in quite a long time. A lot of folks looking at economic weakness, but there's also supply cuts, and the combination really putting upward pressure on crude oil prices. That's helping many of the areas in energy. Healthcare also doing well today. The reason you can see that these two sectors are doing so well, you can see that the exploration and production stocks in that oil space having a very strong day, trying to get through triple top resistance. Biotechs hit major support yesterday and bouncing, helping to lead the healthcare group higher. Among individual stocks, I noticed a little bit ago there were 26 Dow components that were higher, and Walt Disney was the leading stock within the Dow. And on the flip side, though, we do have Carnival Corp, which reported disappointing results. And you can see the stock down 8%, one of the worst performers in the market today. All right, Erin, I don't know if you've noticed going out to the pumps lately, but gas is going up.
You know, I'm in California. Gas is always up. we have so many taxes on our gas. It's just, you know, honestly, anytime I go anywhere, just about, I'm always excited about how low the prices are. So I suspect I would be impressed with yours as well.
Yeah, well, we've gone up probably 50 cents a gallon or close to it just in the past couple, month or two.
Wow.
We were under $2 a gallon. I know that's cheap. I've been out on the West Coast.
I'm trying to remember the last time we saw under $2 a gallon here in California.
Well, we're all the way back up to $2.45 now. I noticed this morning, but yesterday was $2.35. I mean, literally the prices are climbing pretty rapidly, and it's not a big surprise if you've been following crude oil prices, because crude oil breaking to a multi-month high at $60, actually multi-year, I believe, but I'd have to go back. We'll look at that chart later, maybe.
Mm-hmm.
Anyhow, yeah, it's been quite a run on crude oil prices. Really, the only thing keeping energy back, energy's been doing pretty well. But, of course, we've had a dollar that has been fairly strong. And I think those headwinds holding back energy, talked about it, written quite a bit about energy and materials on a relative basis struggling. And the primary reason, in my opinion, is the fact that the dollar has been so strong.
Yeah, it's interesting, though, to see financials also have been struggling quite a bit, too. I'm wondering if we're going to finally see that turnaround.
Well, we need to see the yield start to move higher. I mean, we did get an inversion on the yield curve looking at the short-term 3-month Treasury bond yield, compared to the 10-year Treasury yield. So anytime you see that inversion, you start thinking the increasing odds of a recession. Now, I look at some other things that don't tell me that, namely jobs. We did have a pretty disappointing report that came out earlier this month. I'm really going to be interested to see what happens in the next week or two when we get the next jobs report, because normally what will happen is you'll see a pretty significant deterioration in the rate of change in the jobs going, looking back over the last 12 periods, that rate of change begins to slow. And that's a pretty good indication that the stock market could have some trouble ahead, but we're not really seeing that yet. So some mixed signals for sure.
Absolutely. That's why we're here.
Yeah. Be totally confused in front of a big audience.
Exactly. All right. Well, you can see we've got quite the schedule coming up. Doug Bush from Chart Smarter will be here tomorrow. Dan Russo is always fun to talk to, and he'll be here Thursday. And then next week, we are starting our special StockCharts.com anniversary week. I can't believe it, Tom. How long have we been around now? I know I haven't been around with stock charts as long, but.
Well, stock charts have been around 20 years. I haven't quite been around with stock charts that long. I think I started writing in the Chart Watchers newsletter in 2006, though. So it's been about 13 years writing.
Right.
In 2015, full time.
It's going to be exciting. So we have lots in store next week you'll want to pay attention to. All right, today I will be starting off with the Reverse Divergences workshop. I'll give you a look at classical divergences, and then we'll also talk about those reverse divergences. 10 and 10, our first symbol will be SBUX, and our final segment, Under the Radar. Tom's going to give you what he is looking at under the radar as far as stocks, and I suspect they're coming off your strong earnings chart list.
Actually, they're not.
Oh, well, then that will be even more interesting. All right, well, let's go ahead and get started with the technical news and headlines.
All right, sounds good. Let's go ahead first and look at some of the economic reports. We didn't have much out yesterday, but we did have quite a bit this morning. February housing starts came in below expectations, as you can see. Building permits close to expectations, but slightly below. The January Case-Shiller home price index rose 0.1%, also below expectations. And maybe a little saving grace there, January FHFA house price index rose 0.6% versus 0.4. So we at least got one decent report out of the housing. The other three a little disappointing. March consumer confidence was out at 10 o'clock this morning, 124.1 versus 133. And, of course, that was not very good news. And as we take a look at the 10-year Treasury yield, we did gap up at the open, but this downtrend remains in play. And this is the fifth consecutive day that we have put in a lower high. So we really can't reverse this downtrend in Treasury yields until we put in a higher high. So we'd need to get back up to about the 2.47 area today, or maybe tomorrow will be the day, but we really need to reverse this back to the upside. And I think what the Treasury market really is telling us, number one, is that the economic strength that we were all expecting or hoping to be there later this year and the next year is not going to be as great as we had thought. It's not going to be as great as the Fed had thought. And I think the reason that the stock market's handling it pretty well is it's almost like the market is believing that we're back into that cheap money era, the quantitative easing. Of course, they have that over in Europe right now. And here in the U.S., I mean, the way the Treasury market's acting, it's like maybe the next rate move is going to be a cut instead of a hike. If you listen to what the bond market's telling you, that's certainly a possibility. So anyhow, I think the market is thinking that, okay, we got slow growth, but the Fed, you don't want to fight the Fed. Everyone's heard that. You don't want to fight the Fed. And if the Fed is beginning to turn more dovish, I think that is a recipe maybe for higher prices in the equity markets. I don't know. But I still would like to see this stabilize. Rapidly declining Treasury yields, 275 to 240 within the same month. That is not a good sign at all, in my opinion, for the economy. Earnings reports. We had a number of those out. One big one last night. Red Hat came in better than expected. You can see Carnival Corp, IHS Markit, McCormick and Company, FactSet Research, Kronos, all reported this morning. All but Kronos came in with better than expected bottom line, but revenues were an issue for most of these companies. And so I want to go ahead and pull up some of these charts so that we can see what's going on here. First up, let's take a look at Red Hat. This is RHT. Now, keep in mind, Red Hat was bought by IBM. So when you look at this, you're saying, well, why isn't it going anywhere? This is a software stock. Many of the software stocks have been on fire. Well, it was a cash deal. And I believe the number's around $190 a share that IBM offered and was accepted. But the deal hasn't gone through yet. So it's actually trading slightly at a discount to that $190 offer price. But that's why Red Hat really is not seeing much of a response. They missed on their top line, $879 million versus $885.6 million. $1.16 versus $1.01 on the bottom line, as I mentioned. But sometimes I think in this case anyway, it's probably better to look and see what's going on with IBM. IBM is up slightly today, up about almost 0.75%. still needing to move up a little bit higher to make that breakout. And when we pull up IBM on a relative chart, this is where I have a little bit of a problem. We've been uptrending on a relative basis to the group over the past 4 or 5 months, but we really need to take out this high. We topped about 2 months ago, 2.5 months ago, and we haven't been able to get back through that level. So I'd like to see IBM break out versus its peers, and that would help it break out versus the S&P 500. Some other stocks, and I'll go ahead and keep it on this relative chart. Let's take a look at CCL. This is Carnival Corp, and Carnival Corp taking a big hit today. And on a relative basis, notice that the recreational services here is actually moving to the upside. So we've got action in the peers that are going pretty well, at least breaking to new highs. But look what Carnival Corp's been doing. It's been actually moving to the downside. So on a relative basis, look at the chart. This is not what you want to see. This is not the kind of stock you want to own. You don't want to own a stock that is underperforming its peers. If you want to be in that space, you got a lot of peers that are going to be doing much better. So when the company comes out and misses on the top line and doesn't provide the report that Wall Street's looking for, we shouldn't be shocked. We shouldn't be shocked when the stock on a relative basis is not performing well. Next up is INFO. This is IHS Markit. Now, this one's pulled back. They were on the verge of breaking out, even though their overall group had not broken out. But if you look at the last 2 or 3 months, there's been some underperformance here, and we're breaking to a new 3-month low, really 2019 relative low today. They missed on the top line. They did beat on the bottom line. They reaffirmed guidance, but it wasn't good enough. If there's one silver lining here, I think you've got some pretty good price support in the 52, 52.5 area, where we've tested that level quite a bit recently. And also that 50-day moving average, which is at 52.82, also providing some pretty good support here. McCormick missed on the top line. So we had Red Hat missing on the top line. Carnival missed. IHS Markit missed. McCormick missed. And when I show you FactSet and Kronos, they both missed as well. So that was one common denominator with all these companies. They missed on the top line. McCormick, however, did beat on the bottom line, reaffirmed guidance, and had been performing pretty well since gapping down back in January. You can see their relative performance since that gap down had really started to improve. So I would say at this point, the stock looks pretty good. It's in that food products area. So it is a little safer, at least in terms of being in a more defensive sector. But MKC looking pretty good, getting a decent reaction to its earnings report, again, even though they did miss on their top line estimate. FDS, this is FactSet Research. And FactSet, here we got the breakout on the stock, even though its group did not make the breakout. So we were seeing some relative strength here. And if we go back, even though we were down early in the day, we did manage to hold on to the support near 230, and the stock has recovered back up near the high of the day. So FactSet looking pretty good technically here. Breakout above 243 or so would be very bullish, I think, for the stock. One area of note is that the publishers in general here have not been performing very well, and they are at the group as a whole is at about a 5-month relative low versus the S&P 500. And then finally, let's take a look at Kronos, CRON. This is a cannabis stock. I think I've talked about this. I think it's been one of the better performers. I really liked the fact that we were holding this, that we broke above this $14 resistance area, went straight up to 25. I mean, did that in about 2 or 3 weeks. Honestly, that's just unsustainable. We needed consolidation of some sort, and that's what we're getting. I would just be careful if we lose about 1875 here on Kronos. As long as it continues to hold this support area, then I think it's fine. Consolidating, likely to go higher. If it breaks down below 1875, especially if the volume starts to pick up, you got to remember this breakout occurred back at $14, and that has not really, we haven't seen a move back to fill back to that area. So breakdown, I would be careful with Kronos, but otherwise, this one remains one of the better stocks out there in this space. All right, some individual stocks or ETFs. Let's first take a look at XLE. I'm just going to pull it up on a regular chart. XLE is trying to make this breakout. Again, crude oil prices doing extremely well. One area that we need to watch, and I'll talk about this a little bit more during the under radar under the radar segment later in the show. But watch this area with crude oil prices continuing to move up. If we break out above 670, 675, even though the dollar is providing some headwinds, I wouldn't be surprised to see some of these under the radar stocks in this space make a breakout. So this is certainly something that I would keep an eye on. In the biotech space within healthcare, here was the move down to test this 1925 to 1950 support area, bouncing nicely in biotechs. Also, some opportunities there. There was a positive announcement out on a small biotech stock. Positive results on ALDX. This company had a phase 3 trial regarding a topical solution for conjunctivitis, and the results were positive. So the stock gapped up, huge gap up at the opens, pulled back. We'll see whether or not it can regain some of its earlier luster later in the session. And then finally, I wanted to just mention Tesla. Tesla has been moving down. I wanted to pull up a longer-term weekly chart first so that you can see we are trying to bounce off of a key area. 250 to 260 has been great support for Tesla for the last year and a half to 2 years. We want to watch that level very closely. And also in my blog this morning, under the historical tendencies, I pulled up Tesla and showed that historically, look at these average returns in April, May, and June. We're almost into April. 9.8, 11, and 10.8. This is the time of the year when Tesla seems to do its best. When you look across here, we had one good month over here in November, but it is really April, May, and June when Tesla seems to get things rolling. So that's something to watch. All right, I want to move into a few upgrades and downgrades before I turn it back to Erin. So let's take a look at first an upgrade. BBBY, which is Bed Bath & Beyond. Nice breakout above the recent high. I'm going to pull this up on a relative chart so we get that 1 year look. We are taking out this high, but we've got overhead gap resistance coming in about 1850. We want to keep an eye on that. But this is a stock in the specialty retail space, one of the best areas in the market. So the fact that we are making this breakout, if we can get through gap support, gap resistance, then I would be looking for, or at least maybe adding this stock to a list because it is going to start, you can see, strengthening relative to the group. It's making a breakout today. Probably one to keep on your radar. Another upgrade was VRTX. This is Vertex Pharmaceutical. And Vertex still got a lot of overhead resistance. 195 is a big level, but it has been holding in the upper 170s as support. Let's see if we can get that breakout on Vertex. Downgrade, CRTO. CRTO, they've got the problems that this company's facing right now is that Google is considering changing its targeting policies around its browser. And there are estimates out there that Chrome represents about 50% of this company's revenues. So if you're wondering what's going on here, that is what's going on. There's a major uncertainty about a big, significant part of their business. So CRTO certainly struggling and deserving of that downgrade. CMCM downgraded as well. This is a stock on a relative chart. Look at the software stocks making a breakout, and look at what this stock has been doing over the course of the last year. So when its peers are breaking out and you've got this kind of relative strength, don't be shocked when you get a downgrade. Not looking good. I would stay away from this. Final downgrade is TS. And TS making this big move to the upside. Been trending higher, holding on for the most part to this rising 20-day moving average. It was downgraded, but I actually think this one, sometimes downgrades present opportunities. Notice that as its group, the steel group, had been rolling over here, TS actually was making breakout on big volume. So we've got really nice relative strength. The problem is that steel is not a great area. So you want to keep a tight stop if you're in this one. But I think a pullback down here into this 27.5, 28 area would be very enticing on TS. One last note I wanted to mention on Bed Bath & Beyond. The Wall Street Journal reported that 3 activists are trying to replace the entire board and their CEO. So that is also creating some stir for the company. And then one final company, they did not get upgraded. They're actually initiated with an overweight at Piper Jaffray. And it's one we've been talking about on here, NVIDIA. So NVIDIA, I can pull the chart up very quick. Well, that's all right. We'll look at the chart later. But here are your upgrades and downgrades that I just went over. Again, Bed Bath & Beyond really starting to turn the corner, and Vertex, we want to watch to see if we get a breakout there, because some of these healthcare stocks starting to show a little bit of strength, at least here in the short term. Okay, Erin, it is time for your reverse divergence workshop, so I will let you take it away.
All right. I'm going to give credit where credit is due. One of our viewers here at Market Watchers Live and a VIP has had requested that I go over reverse divergences, mainly because I talk about them, Carl talks about them, not many other people talk about them, and they're important to think about. I'm going to show you classical divergences, which most people are already familiar with, those positive and negative divergences. It's the reverse divergences that can tell you some very interesting information. And we use them generally with volume and breadth is where I look for reverse divergences, not so much with momentum indicators, but I'll explain as we move along here. All right, so next up. Okay, so what I want to do is I'm going to give you kind of a refresher on using rising bottoms and declining tops. It's definitely a beginning refresher, but we need to go over that. We have the classical divergences and confirmations that I'm going to go over briefly, because I do want to spend more time on discussing the reverse divergences. And I'll give you some examples and how you would analyze, kind of in words and in visualization, what these divergences are telling you. And once you can get to that level, it really isn't that difficult to look and identify these divergences and what they mean. So you just have to think about them logically. What is the chart actually telling you with these divergences? And I'm going to, again, I'll go over that as well. So let's just start with our refresher for beginners. Remember, we usually use rising bottoms and declining tops. When you're measuring support and resistance, or a rising trend or a declining trend, you only use declining, I've got this completely backwards on the slide, you use declining tops and rising bottoms. Boy, that's a test right there for you guys. So what I want to explain is that, when we're looking at rising trends, we always use the rising bottoms, because if you're looking at declining bottoms, it's really just not telling you that much. You could end up setting even lower lows and lower lows. It's not giving you the actual trend. What you're looking for are declining tops, because how would you break from a declining trend? Well, you break to the upside, correct? So that's why we use declining tops and not rising tops. The reason we used rising bottoms is because if we wanted to break a downtrend, what do we have to do? Or break an uptrend? Well, we'd have to break down. And so that's why you need the rising bottoms to define your rising trend. And again, if you're looking at declining bottoms, you're not getting much information here, because it's not going to tell you when that declining trend is broken to the upside, because of course you can come up here and start setting some higher lows, but you're still in a declining trend. So declining tops and rising bottoms, those are your valid ways to look at trends. And the reason I start with that is because when I look at my traditional divergences, those positive and negative divergences, you start with the indicator. And that's where you start with your rising bottoms and declining tops. So with a traditional divergence, you start with the indicator, and you look at whether the indicator is showing you rising bottoms or declining tops. And then what you do is, once you find those on your indicator, then you go up and look at price and draw in the corresponding slope of those bottoms and tops. Doesn't mean that they have to be rising, declining. We're starting with the indicator. So price bottoms and tops, we're just looking at the corresponding. We're not going to pay attention right away to what it's doing, because now we compare the slope. between the indicators rising bottoms and the bottoms on price. If they have the same slope, if we're looking at rising bottoms on your indicator and rising bottoms on your price, that means you're getting a confirmation of that uptrend. If they have a different slope, now you're diverging, right? You're not going with the flow there. Your price tops are starting to, or your price bottoms are starting to go lower, but your indicator bottoms are rising. And so that's divergence. And let's look at it visually. It's a little easier to understand. So remember, we start with the indicator by looking at rising bottoms or declining tops. So we have a higher low, rising bottoms, and then the corresponding price, you go up and look at those bottoms and they are declining. So this is considered a bullish divergence. You want to see momentum shifting to the upside and price is starting to move lower. And that tells you that momentum is building up and it's time for it to start making that move to the upside. So here is a bullish divergence, just like I was explaining. So we have rising bottoms on momentum, but what's happening to the bottoms on price? They're declining. So despite declining prices, momentum is starting to build out of an oversold condition. And that tells me that's positive or a bullish divergence. Momentum is building despite price moving lower, and that suggests that you should look for higher prices, that this declining trend on price should end up being broken. In this case, it worked. All right, so what about a bearish divergence or a negative divergence? Well, we start with the indicator, and again, we go with the tops here, declining tops. And then we look at the corresponding price tops, and if they're rising, that's considered a negative divergence. And let's look at an example. So we start again with the indicator, in this case, the PMO. We have declining tops. But when you look at the price tops, they're rising. So this is telling you with these tops, that is a bearish or a negative divergence. Typically, you don't want to see declining tops on your momentum. You don't want to see momentum sort of slowing when it hits those tops of the momentum. You want to see them rising with price. You want to get that confirmation of the price trend. Right here, you're not getting the confirmation of the price trend, and it's suggesting you might want to look a little more closely. Now, of course, I'm looking at just this example, and we had those declining tops, and we have rising tops here, but we continue down if we want to include this declining top, because we've got 3 declining tops now. And what happened with price? 3 rising. In fact, I can see it's almost parabolic rise there. And that also would suggest to you to look for a decline in price. And in this case, we got it on Arista Networks. All right, so when you have these confirmations, when they're going in the same direction, that is a confirmation. Obviously, you're not diverging, you're going in the same direction. And if you have the same slope, then that means you're confirming what's going on the trend. Now, let's face it, confirmation's certainly not as exciting as divergences. It's pretty easy to confirm trends with indicators. Really what we want to see more than anything are those divergences. But if in the process of looking for those divergences, we miss out and we just can see the confirmations, well, that's not a bad thing either. As you can see, in this case, the indicators tops were declining, so were price tops. That confirmed this downtrend, which did end up continuing. I don't have it marked here, but I noticed rising bottoms from August into September, and what was going on with price bottoms? They were declining. That is a positive divergence. So we would have expected rising prices. Sure enough, we got the rising prices. The indicator, the PMO bottoms, continue to rise, and that confirmed that uptrend. All right. Let's look at reverse divergences. Now, it's basically a reverse of the classical process, because instead of starting with the indicator, it's best to start with price, because again, declining tops, rising bottoms, declining tops, rising bottoms. I mean, we draw those all the time. That's what we're looking for. So to me, easier to start with the price, because now we're looking at, like we were doing for the indicator, we started with the indicator, and then we looked at the declining tops or rising bottoms. In this case, since we're reversing the process, we're going to start with price and then draw the corresponding tops and bottoms on the indicator. Now, typically reverse divergences are used with volume and breadth. You can use it with momentum indicators, but not always. They just don't tend to be as strong when you're looking at those. But they do exist, and I will show you some in any case. So reverse. So we start with price, in this case, declining tops. And then we look at what the indicator's doing, and I apologize for not lining this up, but the indicator tops are rising. So that is considered a reverse divergence. Let's think of this in terms of volume. You have rising tops on volume. You're getting an increase in volume, and then your price tops are getting lower. That is a reverse divergence, right? Because we started with price, declining tops. But what is that telling you? If you have volume on an uptrend, but your price is on a downtrend, price is supposed to follow volume, right? That's kind of one of those, things we talk about in technical analysis. So what does it mean when price isn't following volume in this case? Well, it's a reverse divergence, as I said, and it is negative. It's telling you that despite volume coming in, price cannot sustain the rising trend. So that's what a reverse divergence would look like. Now, when you're looking at the bottoms, you've got the rising bottoms on price, and you have the declining bottoms on the indicator. This is a reverse divergence. Again, you're starting with rising bottoms on price, that classical declining tops, rising bottoms. Start with price on the reverse divergence. So what is it telling you, for example, if we were looking at this in terms of, let's say, momentum. So you're having declining bottoms on your momentum, but you're getting rising tops on price. That is a reverse divergence, again, because we're starting with the price, the rising bottoms. What is it telling us? It's telling us that although price is rising, the momentum bottoms are getting lower. This is actually considered a good thing in that a lot of times when you see the momentum tapering off on the bottoms, price bottoms, you're getting, it's like a way that you're able to work out those conditions where the momentum is too high or you need oversold conditions. Basically, you're seeing that momentum shifting lower on the bottoms, but the price are rising, and that's telling you that you're really, despite this, despite the divergence, you're still getting that rise in price, and that's a good thing because now you're setting yourself up into further oversold territory. And again, we're looking at bottoms. All right, so analysis, as I was discussing. So if you have higher tops on your volume indicators, it's telling you that volume is not able to push price higher. So it's negative. It's a reverse divergence, but it is negative in the analysis. If you have higher tops on breadth, despite rising issues and the advanced decline rising, price is not affected the way it should be. It's unaffected, and that is considered negative. All right, I think this was exactly what I just showed you. All right, so let's look at a couple of, I would call, positive and negative divergences. All right, so here's a chart of AMD looking at the PMO. So we're looking at momentum. So you can see we have the declining bottoms on the PMO, but at the same time, we have rising bottoms on price. So basically, you have these overbought conditions, and they're able to be worked out despite a rise in the trend. And that's positive, right? You want to get back into that oversold territory. And if you're able to continue moving higher and work out those overbought conditions and get your momentum indicator lower on those bottoms, that's a positive thing. And then here we have a reverse divergence that's negative. So you have declining tops on price, you're having the rising tops on momentum, you should be seeing price moving up here. when we're looking at tops. We should see it getting out of a declining trend. We have momentum picking up here, but we're not able to get price out of a declining trend. So that would be considered negative. All right, here is another one. Now we're looking at breadth. And again, I'm going to try and explain it just in terms of what you're looking at here so it can kind of put you in the right mindset. So again, we're going to start, excuse me, we're going to start with, now see there's two here, right? We have the advanced decline line, but we also have the advanced decline volume line. So let's look at this a little bit here. So back here, when we're looking at the bottoms from 2015 and 2016 for the SPY, okay, we're in mostly a, it's flat, obviously. Price is moving in a flat line. And we're getting confirmation from the advanced declines, right? There's, as far as advanced and declining issues, we're staying even. That's confirming this so-called neutral trend, all right? Now, we're going to look at the same thing, but now we're looking at volume. And to me, you're seeing this decline in the volume, right, in the bottoms, but you're getting the price bottoms are staying about even, okay? Or let's look at this. So yes, so it's reversed because again, we're starting with the price bottoms. And if you want to say that they're kind of rising, in this case, I don't think they quite are, but if they are sort of rising here, if you're getting a price trend that's starting to break to the upside, you want to see confirmation from volume. And you're not getting a confirmation from the volume line. You're seeing lower bottoms, and that's not a good thing. So that, in that case, that would be considered negative. And again, it's because we're talking about breadth and volume. You've got to think of it in those terms. So here we are in a declining price trend, right? We started with the declining tops. We're seeing rising tops on the advances and declines. We're seeing rising tops on volume. So what is that telling us? Well, it's telling us despite volume rising, despite advances and declines rising, you're seeing that decline in the price tops. You're not getting the push that you want to the upside out of this move, okay? So typically what you're looking at, right, is you're getting, your breadth is improving, your volume breadth is improving, but your price tops aren't improving. And typically, so number one, it's a reverse divergence, and typically this would be negative. Now, I mean, let's say here we're looking right now, and you can see that we did end up breaking out to a rising trend. So this didn't end up really amounting to much for us here, but that is the mindset. And of course, like I said, these don't always work out. So hopefully that makes sense. Like I said, think about what the chart is telling you, what's going on in that background. So if you have those lower bottoms on your indicators, you know, price is managing to resist this internal blowout. You know, you're starting to lose that, those volume or those momentum bottoms are moving lower, but price is resisting that and it's continuing higher. Now, lower bottoms on your volume and your breadth, but price is rising and the trend, so prices are rising despite that lower volume or breadth, and that's a positive reverse divergence. All right, so let's look at a couple right here. This is our ITBM and our ITVM. And what you can see again on this, in this case, is you have reverse divergences. We start here with price, we have rising bottoms, and then we look at our indicators and we're seeing declining bottoms on those. Reverse divergence. Okay, is this a positive thing or a negative thing? Well, we were able to get through and out of, you know, we were able to move into oversold conditions despite the fact we had these rising price bottoms. We've now worked out those overbought conditions in a rising trend. That's positive, right? Because you're able to work out those overbought conditions. A lot of times what I talk about with people too is that you might see price rising and your indicators are rising with, that's obviously a confirmation of what's going on in the trend. But a lot of times you're going to start to see the opposite occur. So you've got your price is rising and it's getting held up. And then you end up with that reversal in trend. based on these divergences. So let's look at another example here. So here's another reverse divergence, and we're looking at the AD line for the New York Stock Exchange versus price. So here we had the flat price. We had the advanced decline line is moving lower. So we were able to work out what I would consider overbought conditions as we moved lower on this advanced decline line, and we were able to hold the trend. So that is a reverse divergence. Now, when we look at the tops here, we've got these rising tops. And in fact, I would draw this a little bit lower. This should be rising bottoms because we're starting with the indicator here. And that would be coinciding with those rising tops or rising bottoms. You can also compare the tops here. I mean, let's face it, you've got a rising trend in price. Let's get back here. You have a rising trend in price and a rising advanced decline line. So that's confirming the trend right there. All right, let's look at one that is actually recent. I think, yep, I pulled this off today, this morning to look at because there's slightly different divergences going on here. So we have to see what are they telling us. So in this case, we're looking at tops that are declining. Remember, we started with price, so we're looking at a reverse divergence. So price tops are moving lower. But what's happening with our AD line? Okay, so there's the AD line, and then there's the advanced decline volume line. So we're subtracting the volume, not just the number of issues. So declining tops on your indicator, that's a confirmation of the declining trend, right? Declining tops. If you're going in the same direction, you're confirming. When you diverge, that's when we start talking about what's going on here. So we have declining tops on price, but when you look at the volume line, you're getting a rising volume, right? So is this a positive thing or a negative thing? Well, you have price that's starting to move in a declining trend. Your volume is moving higher, but it's not, price is not following volume here. Price is not following volume, and that's a negative thing. So not only do you have the confirmation of the declining trend by the tops on the AD line, but you also end up with this reverse divergence, and that is also a negative thing. Volume is pushing higher, but price is unable to push higher. All right, so I'm already ready to do some takeaways here, and then we'll go ahead and I'll look at some of those charts just one or two more times just to make it more clear. In fact, we can probably pull up a couple of charts I'll look at. But as far as our takeaways, classical divergences, you start with the indicator. Okay, so you have declining tops on an indicator. You're going to end up, you look for rising tops on price. If you have rising bottoms on an indicator, you look for the declining bottoms on price. And that is a classical divergence. Reverse divergences are pretty much the opposite. You're starting with price. You have declining tops on price, but you have rising tops on an indicator. You have a rising bottoms on price, a rising trend, but you're getting declining bottoms on an indicator. Those pretty much are what you're looking at as far as a reverse versus a classical divergence. So let's go ahead. I'm going to look at a few charts here. Let's move us into, there we go. All right. So we do have these wonderful chart packs. Let's see if I can find my mouse likes to disappear on me when I come out of the, let's just do it this way. There we are. Okay, so the decision point chart packs, one of them is our decision point market indicators chart pack. These are free. You have to be an extra member above just because you end up with multiple chart lists, and basic members only have one chart list. But there are all the various indicators that we can look at and look for these divergences. So why don't we look at the McClellan oscillator? Let's see if we can find anything here. I'm going to make this so that we can see it a little better. Take up a little more space. All right, so we're going to start with, let's start with price here, right? So we want to look for declining tops or rising bottoms, and then make some comparisons with the indicators below. All right, so let's see. Let's try this declining tops. We're going to make this annotate. So here are some declining tops here. We can just go to those two. And now we have rising tops on this one. Let's see what's going on with the summation index during this same time. As far as tops, declining tops. And we have declining tops on the McClellan oscillator. All right, so indicators, classical, right? Declining tops is a classical setup here. So we need to compare from the indicators these declining tops versus price, and they are confirming a downtrend. All right, so that is a confirmation. But if we look at this and we compare the actual oscillator to the price tops, we're seeing that the indicator tops are rising. And so what is that telling us? Is this a good thing or a bad thing? Excuse me. Well, if we've got these indicator tops moving higher, we would want to see the price tops also moving higher, but we're not seeing that on this indicator. So the McClellan oscillator is simply you subtract the 19-day EMA from the 39-day EMA. So we're looking at trends, we're looking at EMAs, prices. So again, with rising tops here on the McClellan volume oscillator, it's saying that we should be seeing a rise in the price tops, and we're not. And that's a negative thing. So we ended up with declining tops on the indicators in a classical bearish confirmation, but we were able to also confirm by looking at the fact we have rising tops on the McClellan volume oscillator. Volume is increasing here. We're getting a rise in those volume trends, but price is not confirming that. It's actually going the opposite way, and so that's bearish. So in both these cases, we got bearish information, but in a different way, through a reverse divergence and then through confirmations, where you had price declining along with the indicators. So that pretty much wraps it up for the reverse divergences workshop. Let's go ahead and pull up the poll, and I'd be curious what you think about reverse divergences, Tom, like if you've ever looked at any of those.
I don't use it.
Mm-hmm.
I just haven't studied it enough to, really come to any conclusions as to how it would work in my trading. So I've not really got into it, but I do use regular divergences quite often.
Sure. Well, like I said, reverse divergences, I feel like Carl and I are pretty much the only ones who talk about them. I mean, I even did a search on our stock charts website, and when I clicked, I put it in quotation marks for reverse divergence, and then did a search, the only thing that really came up was blog articles by Carl and I. So some people talk about them as hidden divergences, and I think the first time I did the workshop, I did call them hidden. So I think it's really cool, honestly, that really more than two-thirds of the audience at least have heard of them. So that's good. And a third of you actually look for them, just like you look for your positive and negative divergences. I don't use them regularly, but I do look for them, because confirmations are just not that interesting or helpful, in my opinion. When you have indicators going the same direction as the price trend, it's a confirmation of what's going on, but I suspect you can find a lot of information to confirm. What I want to find out are when things are not going in the same direction, and why is that? What is it telling me? And price following volume, that's just, like I said, I think we've all talked about that and heard that. If your volume's rising, you should see prices rising, but if they're not, then that's a reverse divergence. That's telling you that there's a problem. You're getting volume rising, but your price tops aren't rising, and again, that's an attention flag.
Mm-hmm.
So
yeah, I mean, everybody's got their own way of approaching the market. And certainly these divergences, reverse divergences. I mean, I've taught classes where I've shown divergences. Some people pick them up immediately. Others the exact same thing and just cannot grasp, what they're telling you and so forth. So I think it really does come down to the individual as to whether or not they, it's something that's meaningful. And I'm not talking about the reverse divergence. I'm talking about regular divergences. But yeah, I find that those divergences can be very significant for me in terms of managing risk.
Yeah, and I mean, I really use them more often than not on indicator charts with like the McClellan, the 80 lines, that sort of thing. I think they're far more useful in that way, except for the OBV. Like I said, I think the OBV is a great tool for looking for those divergences. But with momentum, with the PMO, I don't reverse divergences. I'm more interested in those positive and negative ones.
Right. I would agree. I would agree. All right. Well, it is time to get into the 10 in 10.
Starbucks, number one. And I'm going to grab what I can find in here in the chat room, and then we'll see which one's the most popular, and that'll be the next one. So,
all right. Well, let's go ahead and jump into Starbucks. First of all, I'm a fan of Starbucks, not just because I go in there every day, but because I actually like their stock and the chart. I think the chart looks really good. I think there are better stocks out there. I really think Chipotle is the best one in this space. But Starbucks has been great. I mean, beautiful move up in November, consolidated it, then broke out again. But it's more of what's going on in the restaurant group as a whole that's got my attention right now. You can see restaurants moved up in November about the time that Starbucks was moving up. And then it consolidated and went sideways for a while. And before it really made a definitive breakout, it went a little bit above this prior high. But you can see Starbucks already making the high and holding it. So the relative strength was there. And as we scroll down here, you'll see that over the past 8 or 9 months, Starbucks has been a great performer relative to the restaurants. So if the restaurants are good, if you like what's going on in the group, then I think Starbucks is certainly a very good candidate to own. It's also obviously outperformed the S&P 500. But the thing that, I've circled a couple things here. Number one, after just crazy outperformance by the restaurants versus the S&P for 3 months at the end of the year, so in the fourth quarter when everything else was really, really weak, if you look at the absolute chart on the restaurants, yeah, we had some downtrend in the month of December, just like the overall market. But on a relative basis, this was a group that was really performing well in the fourth quarter. And even when it was taking its tumble in December, the group was not dropping the way the S&P 500 was. Now, since we've come back, the overall market's been doing, much better the last 3 months. Restaurants, I would say, have just been going along for the ride. But notice that for the first time in about 7 or 8 weeks, we just moved to a new relative high on the restaurants versus the S&P. And on an absolute basis, we just got that breakout. So I think this is a group that you want to be considering in your portfolio, at least having some kind of representation. And I think Starbucks is certainly a great candidate. I think the chart looks good.
All righty. Let's see what is the most popular in the chat room. Boeing.
All right. Well, Boeing. Yeah, Boeing has struggled here since obviously the plane crash, second one in several months with the 737 MAX planes. We broke down last Friday below the prior lows. We did, cling to this gap support, bounced yesterday. Now we gap up today and we're falling back down again. Notice the 20s now crossed below the 50, and there's been a tremendous amount of volume supporting this. Obviously, with Boeing struggling so much, you've got aerospace dropping, but Boeing is dropping faster than the overall group. So there's still hope in some of the areas within aerospace, but Boeing is putting, definitely a major, major drag in this area. So I just think right now there's too much uncertainty. I think if I was trading it, I'd watch gap support, which is trying to hold. Anything below 360 would really make me nervous to the downside. Top side, I think the first test of the 20-day is going to be a big one. We've been struggling around 380. When we've been breaking above 380, we don't hold it. Now we've got the 20-day dropping down to about 386. So I think you've got some overhead issues there. and going to be trying to hold on to support at 360. But if it fails, I'd be careful with Boeing.
All righty, let's see here. How about TJX, our apparel retailer?
Yeah, I never did actually annotate anything. I just rambled.
Well, you have plenty of time to do that.
Yeah, I think on Boeing too, what I would be looking at here, you can see that volume. I mean, the volume, you look back and that volume is unprecedented, at least over the course of the last year. So the fact that it's broken down and trending lower, big volume, I think you just got to be really careful here with Boeing.
All righty, let's see. Next one up. Oh yeah, TJX. You got to do that one still.
Yep, TJX. All right, so TJX trending higher, holding the 20-day moving average. That's good. And it's been trending higher when the apparel retail group, for the most part, just been going sideways. So you do have one of the leaders with TJX in a space that's just kind of so-so. The group relative to the S&P, you can see topped 4 or 5 months ago, been in a downtrend. So again, my strategy, if I'm playing a good stock within a bad sector or within a bad industry group, or maybe just a little bit of a lagging industry group, is to not make any excuses. If the stock breaks down, remember you're not in a very good group, and as a result, I would have a much tighter stop and really wouldn't have any I wouldn't be trying to make any excuses. I mean, you could see all these 20-day tests just time after time. So any move down below that 20-day moving average on a closing basis, given the overall group, would bother me. So that's where I would probably consider my stop.
All right, let's see. Next one up is going to be Plantronics, PLT.
Okay, it's pulled back quite a bit, but it's in a good group. It had been an underperformer for quite some time. It started to strengthen. Now it's rolled back over. Okay, I don't like that right there. Yeah, it's in a good group. Let me just say that. The support that I would watch would be that gap support. I mean, if you're in a group that's outperforming and you gap up, which looks like you're breaking this downtrend, I mean, that kind of is a little bit of a character change. I would not want to lose this support. So I would go down there and maybe even that little intraday tail right there. I'm going to say $43, $44 is key support. Resistance is up near 52. That's the trading range for now. But again, you're part of a really strong group. There's no reason for PLT to go back down and lose this support area. If it did, I'd be out.
Okay, let's see. Next one up. CMCM, building materials.
All right, CX. Yeah, not good. I mean, it's that support. I'll give it that. But look at it relative to its peers, awful. Relative to the S&P, awful. And now its peers over the last month or so starting to roll back over again, breaking an uptrend. So there's just nothing here that is compelling to me. A value investor might, I mean, I don't know too much about the company from a fundamental perspective, but technically we're down at a key support level. But again, if it fails to hold that support level, I mean, a downtrending stock that goes into sideways consolidation mode, I'm anticipating is going to break down. Now, I don't believe we're in a bear market, so that might help a little bit. But when I'm in a bull market and I see a stock moving higher and then consolidating, I'm expecting a breakout. Well, the same holds true in a downtrend. I'm expecting a breakdown to the downside. So I don't like playing these support levels unless longer term, if we put up a chart, if this was a major support level, maybe in a longer term uptrend, then maybe. But I'm not really seeing it with the group in terms of relative strength, so I would avoid the stock.
Okay, let's see. Next up is Trade Desk, TTD.
I can tell you already I love this stock. It is on my strong earnings chart list. I think this pullback is probably going to present some opportunities, especially if it gets back down to the top of this gap support. But what I like in the stock is, and if you've been listening to the show, I think you will understand here. But anytime I get a stock that's doing this, trending higher, software trending higher, TTD relative to software, relative to its peers trending higher, relative to the S&P trending higher, and software relative to the S&P trending higher. These are the types of stocks that I want to own. Now, yes, you're going to have periods of selling, but normally what that does is presents an opportunity. So I would be watching. The biggest level to me is going to be the top of gap support. Massive volume, huge gap up, opened at 175, 176. If we were to get back down there, even close to the 180 level, I think TTD starts to look really good based on its track record of outperforming.
All righty. Next one is OSIS, and that's OSI Systems.
Yeah, this is another one.
A long way since the $6 million man, right?
Yeah. This is another one that's on my strong earnings chart list. I think it made a huge breakout, and another one that maybe on a relative basis that its peers doesn't look so good, but for the most part, you can kind of see the same thing. The group was weak back in December, but it has come roaring back. A lot of volume, it breaks out, and so on a relative basis, it's trying to hold above this prior relative low and turn back to the upside, and it's getting close to an area where you would expect that it's going to start moving higher and outperforming again. So I actually do like this one. I think the entry points are there and probably at this tail down here, because over 1 million shares traded this day, which is very heavy volume as you look back. And the buyers stepped in at about 81.5. So intraday we were selling, and then all of a sudden this is where the wave of buyers came in. So that to me is a major support level. I think you should get closer down to that 82, 83, 84 area in here, that it's an accumulation zone on OSIS.
Okay. Let's see. We haven't looked at this one in a little while. Alarm.com Holdings, ALRM.
Okay, ALRM. I don't like the big volume drop, but we're trying to get back through. Here we had selling. This is exact opposite of what I was just looking at. Here we got a big gap down and on heavy volume, and then we see buyers to 62.50, and then the sellers come in. Since then, we've had one close over 62.50, and then moving back down to the downside. The good news is we're in software. Software has been awesome. So perhaps this is just a little bit of a temporary move down. Maybe this will turn out to be a little bit of a cup handle. I know it's not a perfect pattern, but that type of a pattern where you're off of an uptrend, you come back down, consolidate for a bit, and then start to turn back up. I do think, though, the lows that were set on that volume need to hold. So I'm going to annotate. And looking at the stock, there is your intraday low. Here is basically your candle body highs and lows right around 57.5. So I'm going to say 54 to 57.5 needs to hold. And what you're ultimately looking for is a breakout above 66.
Okay. Next one up, how about PepsiCo, PEP?
All right, Pepsi. I like the breakout here. Nice volume coming in. And look at the soft drink index, not even close to the highs. So I think with Pepsi, you got a lot of strength here in 2019, both on an absolute and relative basis. Soft drinks have not really been in favor. So you got Pepsi breaking out when the action in the overall group has not been very good. So this is another one where I would say, okay, I'm fine with the stock, but I do want to make sure that we hold on to some key areas of support. And for me, holding price support at 120 would be nice, but I think really what we have to do is make sure we hold this rising 20-day. That has been holding there, here, well, there, and once again there. So we've had 4 successful tests of the rising 20, and since then we've gotten more volume and a breakout. So I like Pepsi. I'd prefer Coke actually in terms of product, but on the chart I really like what's going on here with Pepsi. Just watch that rising 20-day moving average. That's where I'd keep my line in the sand.
Okay, let's see the next one, and actually I believe the last one is EOLS. And this one is it's a pharmaceutical in any case.
ELOS?
EOLS.
My bad. So what's your choice, Pepsi or Coke?
Oh, me?
Yeah.
I'm definitely Coke all the way. Pepsi is not okay for me at a restaurant.
I actually like this one. I don't know what the volume looked like here. Yeah, it's plenty of volume. I love this gap up here with all this volume coming back down, and it looks like it went just below the gap. If I was getting into this, I'd get in with a stop, an intraday stop below today's low. So this would make it pretty easy. I like stocks that go below support and then come back up, because then I can put my stop in down at that low. So right here is where all the buyers came in at around 20. And we go just a little bit below, get down to 1967, and now the buyers start coming in, and we're back above this level. I mean, if you wanted to give it a little bit more room, I'd say give it to the bottom of gap support, which is down closer to 18. And if I was doing that, I would buy half here, and I'd buy the other half down closer to 18 and keep a close, fairly tight stop there. But this is a stock that was just up to 30 recently. So when you're talking about here having tight stop, you have the ability, perhaps moving back up to that 30 area, which would be 10 in terms of reward, or 9.5. So you can keep you have a very, very solid reward to risk here on the stock. Now, I don't know anything about this company unless they've had a name change. I don't recognize it, but that was a lot of volume came in beginning of February, and now we are testing key support. So yeah, this would be a good one, I'd say.
All right, excellent. That does complete the 10 and 10. Here are the symbols that we just went over. I will have these up in the Market Watchers Live chart list. Just go to the blog's article tab, click on the Market Watchers Live blog, and you will have the link to all of these right there at the top of the blog page. All right, we'll be right back after this message.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy.
All right, it is time for our final market update. Let's take a look at what the markets have been up to. Well, as you can see today, we actually broke above the declining trend we've been looking at the past couple days, with a nice gap up on the open for the Dow, S&P, as well as the NASDAQ. And then, we hit those intraday highs, looks like about mid-morning, and now we have been declining ever since. But we are still looking at rising markets. Dow is up currently 0.43%. NASDAQ's up about 0.2%. You can see S&P 400 hit its intraday high, is coming very close, though, to yesterday's close, but also broke from a short-term declining trend. Russell 2000 continuing its rising trend that started at that low we had yesterday, but it is pulling back now from the intraday high. It'll be interesting to see if it can hold this 1520 area, given that that was resistance over the past 2 days. TSX, Canadian markets, also gapped up and are moving lower, but still up right now, almost 0.5%. Treasury yields mostly unchanged, reading 2.42%. Volatility index moving lower, currently with a reading of 15.4. UUP up on the day, consolidating sideways. And you could see GLD, we ended up with that gap down, but we've been consolidating sideways on gold since the open as well. USO, big gap up, but pulling back at this point. We can see that TLT is mostly unchanged, but down slightly, 7 cents to 124.99. Quick peek at our sector summary. Right now, the leader, interestingly enough, is the energy sector, followed by healthcare and comm services. All of these up over, looks like comm services and healthcare up almost 0.75%. And all sectors in general are rising, as you can see. Materials, though, is the laggard, up only 0.1%. And that's all I have for the final market update. I'm passing it back to you, Tom.
All right, I'm looking at the NASDAQ on a 60-minute chart, and I wrote about this in my blog this morning that, my focus was turning more in terms of the short term. I was, wanted to see whether or not we could get back up above the 20-hour EMA after falling below it. You can see during most of the rally here off of that March 8th low. Once we got above the 20, for the most part, we had a negative divergence, went back down, held the 50, and then broke back out again. But with all the selling that we saw on Friday, we lost that 20-hour EMA, failed when we got a little bit of a rally, and then failed again yesterday, didn't quite get over it. Today, we gapped above it. So I thought that that was going to be a pretty good sign. We've now pulled back, and we're right at this 20 hours. So from a NASDAQ perspective, if we could get that break, move back up above this high from earlier this morning, I think that would be bullish. If we fail and we continue to drift lower, then what this is beginning to tell me is that moving averages are not helping on the short term. They're not really holding, and that normally leads to further consolidation, a directionless kind of a market. So, and with the daily negative divergence in play, that's why I want to know, are we going to continue to trend higher, or are we going to be looking like, we're going to be trendless, in which case I think when we go over and take a look at the daily chart, you can see with the higher prices and the lower PPO, that could lead to a move down to test that 50-day moving average, and also perhaps even go back down and test that earlier March low. So that's why I think in the short term, it's going to be important to try to see what the market wants to do. Yesterday, we hold the rising 20-day moving average. But again, when we're looking at the 20-hour, can we hold that and start to turn it higher? If not, then I think we could be in for some difficulties. All right, we're going to go into the final segment, under the radar. And there's a lot of different ways we could take a look at under the radar. Sometimes when I'm looking at under the radar, I'm thinking about stocks maybe that are trading with unusual, volume levels, or maybe they're making price jumps and there's no news out there. What I wanted to do today was actually look at an area of the market. I talked about energy earlier. And so energy has just been kind of, I don't want to say floundering, because we are putting in higher highs and higher lows. But looking at their absolute chart versus their relative chart, and I'm going to change this to a solid line chart. But if you look at it relative to the S&P 500, I think we can now say that it's floundering. Yes, it's going higher on an absolute basis, but we actually set a relative high back in early December. We tested it in the second week of January, and we have not been able to break out. And part of that has been because we have seen the dollar continuing an uptrend. So if I pull up the US dollar, anytime the dollar is rising, and off of that second week of January low, we had this big move up. But look at the dollar drop in March. And yet with that huge drop in March, we haven't been able to get that breakout on energy. So I think that energy right now is definitely under the radar, because it's not performing very well relative to the S&P 500. And the reason that it's underperforming is really simple. It comes down to two groups. You've got your production and exploration stocks, or exploration and production stocks, which are not making a breakout. They rose into January, and the last 2.5 months, they have not been able to break to a new high. So if you want energy to begin to lead, we need to see this area break out. And I think it's pretty clear as you come across here that about 665, 670, that is the area we need to get through on this particular chart. Now, also, I can pull up in the same, well, that's not it. No. Don't need REITs. Also, oil equipment and services. And you can see the same thing. Now, we did actually get a little bit of a breakout in February above that January high, but it looks very similar. We've got the same kind of characteristics where we had a nice rally into the first half of January. And since then, really, we have just been looking at this sideways action. So the XLE is really having problems getting going, because we're seeing production, exploration, oil equipment, and services. These two groups just can't get out of their own way. So what I thought I would do is look for some stocks that are showing some interesting characteristics within these two groups. So let's start with the oil production and exploration stocks. And I am going to take a look at some companies that I think are worth mentioning here. So the first one is Cabot Oil and Gas. And let's start by doing I'm going to do a 1-year chart. But you can see after going sideways all the way into, fourth quarter, we made a nice breakout with volume, pulled back in, put in that higher low, and now we're working our way back up toward this high. If we get a breakout in the group, I think Cabot, if we could get that breakout above about 27.30, could be a leader within the group. So if we look at the relative chart, you can see that the group has not been performing well, but look at Cabot Oil and Gas trying to get a relative breakout. So this is a stock that I think is sitting under the radar, mostly because the group has been so weak. If we could get a breakout on the group, I think that COG, Cabot, looks really interesting, especially if it gets that absolute breakout right there. All right, let's stick with the relative charts. Here's another stock within this space. Cheniere Energy looks kind of familiar, trying to get that breakout on an absolute basis while the group is horrible. So you've got one of the stronger stocks within the space. LNG, I think, looks very interesting. Look at it pulling back here, testing its most recent breakout close to 67. This is one that I would keep an eye on. Again, it's going to be somewhat dependent on the overall group, energy. But with crude oil prices rising, getting up over $60 a barrel, or at least they were earlier today, I think energy is at least worth considering. And I would be looking for some of the best, like we've seen with these two. There will be other opportunities, though. Look at NOG. NOG kind of going along for the ride with its overall group. And so you can see on a relative basis, this one's not been one of the leaders. So you say, well, why would you be interested here? Well, look at what's taken place here in the last couple of weeks with this volume. I look back and I don't really see this kind of volume at any point really in the last 4 or 5 months. And so this last rally to get back up and try to break out is coming in with what appears to be a lot more accumulation. Now, it doesn't mean we're going to get the breakout, so I'm waiting for confirmation. But if we were to get a breakout, this was a stock that was $4.50 back in October, a breakout above 290 with what appears to be some accumulation, especially if the overall group breaks out. I think NOG qualifies as an under-the-radar stock. CVE, Cenovus Energy, kind of similar. It's showing a little bit better relative strength than NOG and not as much as the others. But I like, again, the volume coming in on this breakout, this triple top breakout above about 8.25. The volume was very strong. When we came back down, we essentially held this area as support, went back up, got a double top. I look at this maybe as a little bit of a cup, and I think this pullback could be interesting because off of an uptrend, if you don't want to consider it a cup, perhaps it's equal highs and higher lows. So you got an ascending triangle. Either way, a breakout above 925, 930 with increasing volume would be bullish. And then the last one I have in the production and exploration area is Noble Energy. And here's another one. While the group hasn't made the breakout, Noble Energy has made the breakout, pulled back, held that rising 20-day, and now it's breaking out again today. So this is a stock that I think potentially could run back up here to this 28 area now that it's clearing some overhead resistance and with the volume. So another stock, especially if we start to see a little bit of strength coming out of the production and exploration stocks, I think Noble Energy could be a good play. All right, I'm going to move on now to the oil equipment and services stocks and take a look at a couple of these. These I didn't find as enticing, but let's go ahead and look at them anyway. DNOW. I like the volume here coming in on this huge move to the upside. And really, you've got great support down around 13 or maybe just below 13. Stock is currently trading at 14. It was just up at 16. A little bit of a drift here down closer to that 13, 13.5 area, I think starts to set up a much better reward to risk. And if you look on a relative basis, this is a stock, again, showing relative strength versus its group. It just needs its group to get going. And when I look at the volume trends, I see improvement. Relative strength is good. We just need to get the overall group going. So it's under the radar because it's just part of a group that's going nowhere. CVIA. Really nice volume here in March, all of a sudden. And I almost see a little bit of a bottoming head and shoulder pattern, perhaps. If you go across here, you can see downtrend, left shoulder, neckline, head, right side of the neckline. This could be coming into a right shoulder where we had really good support on the left shoulder over here, mostly around the 5.5 area. Notice the double top breakouts about 5.5. So you got the 50-day, the 20-day, and price support that all should be converging in here between about 520 and 575. Stocks at 604, a little bit more of a pullback. You know, it's an aggressive play, no doubt. This has not been a great performer. Unlike the others, most of the others I've shown you, this is a stock that's been underperforming its group, and its group can't break out. But the fact that it's starting to show some volume and it's pulled back here over the last week, probably to the tune of about, I don't know, 14, 15%, maybe a little more than that. This is one that I think maybe warrants some attention. But if it failed to hold that the moving averages and all bets are off. This is one you want to be careful because it is in an underperforming group, and it has been an underperforming stock. OII. This is Ocean Engineering. Or Oceaneering. Combine the two. Yeah, this one, I don't even know why I pulled this one up, to be honest. It looks okay. We did try to make this breakout above the prior high. It is coming back up after holding the 50 where we went below last time. A breakout above 17, I definitely could see it start to improve. Oh, I think this is why I liked it, because it did, on the latest move to the upside, it moved to about a 5-month relative high versus its peers. So that was the reason, and you could see the volume picked up on that as well. So if we can get that breakout above 17, and especially if the volume confirms that, then I could see improvement here. So this is one maybe under the radar. But those were the energy stocks I had. Now, I mentioned NVIDIA, and I'll get to that one in a minute. But I mentioned earlier NVIDIA. I was looking at the semiconductors because they've been actually performing very well. Actually, let's just take a look at the chart here first. So semiconductors have really had a good start to 2019. Yesterday came down, tested the 20-day, bounced off of it. Mentioned yesterday how the semiconductors, many of them were struggling, but they had been leading the market. So you got a little profit taking now all of a sudden today, putting in a higher high, higher low. The group trying to bounce off of that little bit of weakness we saw. But what I wanted to look for were stocks maybe that haven't done great necessarily over the 3 months, but are beginning to show some improvement. So these are not going to be the high flyers in semiconductors, but these are ones maybe that might grab your attention. So let's start with diodes, DIOD. Huge move on increasing volume in February. This stock ran from 30 on January 22nd to 44 and change 1 month later. That's almost a 50% increase in market cap. The company's valuation increased by almost 50% in 1 month. Now we've been pulling back. You can see we've been failing at that 20-day. I don't know, with an overall group that's strong and with this one showing leadership in February, I'm watching because the breakout occurred around the 35 area, 35, 35 and a half. When we broke out, we pulled back just below 35. And here we are just below 35 again, actually sitting at 34.91. So this is a level where this could be an interesting trade. Now, I'd feel much better about it if it gets back through the 20-day moving average. So that's something I would watch. All right, Photronics. This one definitely is weakening. It has hit price support, but it's in a strong group. And look at the PPO turning up as we go down and put in this last low. Also, look at the volume seemingly drying up from what we had seen previously. So positive divergence at price support in a strong group, worth mentioning. Microchip. Microchip had a great earnings report back in February. It's on my strong earnings chart list. Got gap support that comes in about 82 and changed up to 83. And notice that's where we've been holding. So yes, it's been under the radar here for the last 6 weeks, but this is a level we could see renewed buying interest coming in on Microchip. TSEM, this is Tower Semiconductor. Another big move in February, but profit taking coming down into this gap support zone. Yesterday prints a hammer, right on the 50-day. I would not be surprised to see this one start to make a move to the upside. And just a couple more here. Skyworks Solutions, big gap up with earnings, pulled back, I think is just consolidating. It's done nothing in the past 7 or 8 weeks while the semis continue rising, but I do think it's just consolidating. I expect the next move here to be higher. Micron MU, beautiful move late last week, and I believe that was earnings related. Nice move up. Couldn't get the breakout, though. I think we even talked about being careful not to jump in until we see a confirmed breakout, and instead we've come back down. But we're now at gap support and pretty close to a trend line support here. So Micron, I would say, because it had been a laggard for a while, starting to show a little strength. I like that volume move to the upside, but the last few days pulling back. So I would be maybe thinking that this one is kind of in that under the radar mode. And the last one is NVIDIA. So I mentioned earlier talking about upgrades, and NVIDIA was initiated with an outperform today at Piper Jaffray. And you can see the stock did break to a multi-month high late last week. We've pulled back, but notice the 20-day is now rising, and we're hanging well above that 20-day. Unusual, nothing that's not what we had been seeing. So I think NVIDIA is a little under the radar and beginning to strengthen nicely here. So let's pull up the summary slide, and then we'll wrap up the show. And those were the stocks that were covered. Couple of different areas that maybe you might find something interesting. Not really a segment designed to give you 20 stocks to go out and buy, but maybe there was 1 or 2 in there that might pique your interest that you might want to keep an eye on. Okay, Erin, another day coming to a close, and the market trying to hang on to those gains from earlier. It's been a little bit of a struggle here, though. The Dow well off its earlier high.
I have to say, though, when I was looking at the intraday chart for the Russell 2000, it's looking pretty good. You know, we really are seeing a rising trend coming in, and you know, it's positive. You want to see those rising bottoms, of course, and seeing those coming in on the intraday charts. I'm looking at 10-minute bar charts, so
yeah. And I would just say too, one of the things I like to watch with the Russell is how it's performing versus the S&P 500. And so here, this is another thing that bothers me about the U.S. economy is that the Russell 2000 obviously is only domestic companies, you know, companies that do almost all their business in the U.S. And you've got the S&P 500, which does business internationally. Everybody's talking about how weak Europe is and how weak Asia's been. And so you would think that the S&P maybe would underperform, but it's the opposite. We're actually seeing underperformance over the last month by small caps. So this bothers me a little bit.
Well, and it's getting to that low, as you see on that relative chart. Hopefully we'll start seeing it turn around, because the markets really can't get a good push to the upside without some small cap support.
Yep, and that's a big support, because we have been in this longer term downtrend since reaching that high in June. So I agree. I think that relative support level we need to watch. If that breaks, that to me suggests that the economy in the U.S. is not particularly strong. And I think the last chart I'll pull up here real quick, the railroads is another area you want to watch. And this one, because we do ship goods through railroads only in North America, this one looks pretty good. So that's, you know, we talked at the beginning of the show about all these mixed signals. And again, there's a couple of them right there for you.
Indeed.
All right. Well, you got the upcoming schedule there on your screen. I do want to thank everybody for joining us today. Great workshop, Erin. Appreciate the Divergence session.
Thank
you. Again, want to thank all of you for being with us. Please remember to complete the survey as you exit. I'm sure Erin would love to hear what you thought of the Divergence session. That survey is located below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everyone. We'll see you back here tomorrow. Happy trading.